Hello, everyone, and welcome to our deep dive into one of the most talked about financial metrics, EBITDA. In today's session, we'll unravel what EBITDA stands for, why it's a critical tool in financial analysis and valuation, and, equally important, its inherent limitations. Whether you're a small business owner, an investor, or simply looking to enhance your financial literacy, understanding EBITDA is essential. It provides a unique lens through which to view a company's performance, often highlighting operational efficiency apart from other financial factors. We'll explore its definition, how it's calculated, and when it's most effectively used. So, let's begin by defining this powerful acronym and setting the stage for a comprehensive understanding.
So, how exactly do we calculate EBITDA? At its core, EBITDA starts with a company's earnings and then adds back specific expenses that are often considered non-operating or non-cash. The most common way to arrive at EBITDA is by taking net income and adding back interest expense, tax expense, depreciation, and amortization. This process helps to strip away the effects of a company's capital structure, tax situation, and non-cash accounting entries, giving us a clearer picture of its underlying operating performance. Let's look at a simplified example to illustrate this concept. Understanding this calculation is fundamental before we delve into its pros and cons. One of EBITDA's primary strengths lies in its ability to facilitate comparisons between companies. By adding back interest, taxes, depreciation, and amortization, EBITDA effectively standardizes financial results across different firms. This means you can compare the operational efficiency of two companies, even if they have vastly different financing structures, are subject to different tax rates, or have varying levels of old versus new assets affecting their depreciation schedules. It provides a level playing field to assess how well a business generates profit from its core operations, making it an invaluable tool for industry benchmarking and peer group analysis. Without these add-backs, such comparisons would be far more complex and often misleading. Beyond operational comparison, EBITDA plays a crucial role in business valuation, particularly in the realm of mergers and acquisitions. It is frequently used as a multiple, such as enterprise value to EBITDA, EV/EBITDA, to determine a company's total value. This metric is favored because it provides a quick, standardized way to assess potential acquisition targets by focusing on their cash-generating ability before the impact of financing, taxes, and non-cash charges. For investors and acquiring companies, EBITDA serves as a proxy for the cash flow available to cover debt and reinvestment, making it a powerful shortcut in preliminary valuation discussions and deal structuring. It helps to understand a company's fundamental earning power.
While EBITDA offers clear advantages, it's crucial to acknowledge its significant blind spots. By definition, it excludes interest, taxes, depreciation, and amortization, all of which represent very real and often substantial costs for a business. Ignoring interest expenses means you're overlooking the cost of debt, which is a real cash out payment that must be made. Similarly, taxes are a mandatory cash outflow that every profitable business faces. And let's not forget depreciation and amortization. These are crucial for understanding the need for future capital expenditures and asset replacement. A business with high EBITDA but massive debt obligations and aging assets could be in serious trouble, a fact that EBITDA alone won't reveal. It's a measure of profitability, not cash flow available to shareholders or for reinvestment.
Another significant concern with EBITDA is its susceptibility to manipulation or adjustment. Companies, particularly those under pressure to show growth or attract investors, might adjust EBITDA by adding back various non-recurring or one-time expenses. While some adjustments are legitimate, others can inflate the metric, presenting a more favorable picture than reality. This adjusted EBITDA can obscure a company's true financial health, as it doesn't reflect the actual cash available for crucial activities like debt service, reinvestment, or shareholder distributions. Investors must exercise extreme scrutiny when reviewing adjusted EBITDA figures and always cross-reference them with GAAP-compliant statements like net income and the cash flow statement to get a full picture.
So, when should you use EBITDA, and when should you be cautious? EBITDA is particularly useful for comparing companies in capital-intensive industries like manufacturing or infrastructure, where depreciation and financing costs can vary wildly.
It's also good for assessing businesses with varying debt levels, helping to neutralize their impact. However, it becomes less relevant for companies with significant ongoing capital expenditures, CapEx, or research and development needs, as it ignores these essential investments. The golden rule is to always use EBITDA in conjunction with other critical financial metrics, such as net income, the cash flow statement, and the balance sheet. It's one piece of the puzzle, not the entire picture.
In conclusion, EBITDA is undeniably a powerful tool in your financial analysis toolkit. It excels at providing a standardized view of operational performance, making it easier to compare businesses across different capital structures and tax environments. This makes it particularly crucial for M&A valuations. However, its exclusion of interest, taxes, depreciation, and amortization means it has significant limitations and should never be used in isolation. True financial mastery comes from a holistic approach. Always analyze EBITDA alongside net income, the cash flow statement, and the balance sheet. By understanding its strengths and weaknesses, you can leverage EBITDA effectively to make more informed investment and business decisions, using it as one valuable piece of the puzzle, not the whole picture.